Ladies and gentlemen, welcome to It's Rainmaking Time. This is Kim Greenhouse. If you've been listening to the show, you know that we've covered practically every aspect of finance and money you can think of. There are a few strands left we still have to communicate with you about. I've welcomed back John Olagues, the co-founder of a company called Truth in Options, Stock Options Consultants. Now, John does something very unusual that most people in his position with his experience don't do. He is an authority on helping employees maximize and utilize their stock options. You see, stock options are not as simple as they appear because most of the stock options are never utilized properly for employees. Let me tell you a little bit about his background. He's a graduate from Tulane University, where he captained the baseball team and set many of their pitching records. He applied his BA in mathematics and his competitive spirit to the real world of stock options. And in 1976, he became a member of the Pacific Stock Exchange in San Francisco, trading and managing options positions in scores of different stocks. He joined with Blair Hull to create Options Research, the first service to provide theoretical options values to market makers and to the general public. In 1980, he became a member of the CBOE, where he personally traded more options in more diverse situations than any other trader. We've had him on before, and he really lays out the basics of employee stock options to advance tax and hedging strategies like no other. But today we're going to talk about a whole new level and layer of what's going on in the marketplace. We're going to talk about the volatility index. We're going to talk about some very unusual and unscrupulous antics relative to the downgrade of the S&P. And we're going to talk about naked short selling. And he's going to explain a lot of things to you that you may not know, have never thought about, and have not put together. Ladies and gentlemen, welcome John Olagues to It's Rainmaking Time. Good morning.
Good morning to you, Kim. Thank you for inviting me, and I'll try to be informative and easy to listen to. So first of all, there's a lot of talk about Standard & Poor's downgrading U.S. government debt to AA from AAA or AA+. Some people think that prior to that announcement, after the close on August 5th, which is a Friday, since right before the weekend, they made that announcement, and it seemed to be quite sudden. However, the stock market had dropped several days prior to that, right after the agreement was reached to avoid default, and there was all that hullabaloo about disagreements amongst Obama and the Republicans, and they finally got an agreement on the 2nd, or right before the 2nd, and then on the next few days you saw a big drop. And that preceded the announcement of the downgrade on government securities. So some people think that drop, those several days, was done by people trading on inside information, which was put out either negligently or deliberately by people that were associated with Standard & Poor's. I believe that nothing big happens in the market without somebody doing insider trading.
I want to stop you right here. Are you skeptical? If you are, is your skeptical view actually filtering what's going on? Or do you really feel like you have signs and patterns that are showing insider trading?
Well, my experience is that nothing large happens without people trading on inside information.
Why do you say that?
Because every time a stock moves suddenly, like Bear Stearns was 70, and on Friday, March the 14th, 2008, it closed at 30, there was tremendous buying of puts before that drop. And then Friday, after that drop, there was even more tremendous buying of puts, and the stock opened at 3 3/4 the following Monday. So that's a big event. And so there's always insider trading by tippees, either closely aligned with people that pull off the event or maybe a couple of steps down the line to disguise where they got the information. But no event takes place without insider trading, because that's where most of the money is made, by the traders, cheating on inside information. That's my view of being a market maker on the floor, trading a lot of options, and I've been a victim of that. I lost $600,000 in 1980 in the Santa Fe International takeover by the Kuwait Petroleum Company. okay? It was because of insider trading, and we were taking the other sides of those trades because they were paying these very high prices, and we played a theoretical game. When they bid up the prices, we sell them and try to buy the stock and do positions, but you make yourself vulnerable to extreme moves. You see, so in that Santa Fe case, the SEC got $10 million returned or settled from these guys who were cheating. But the SEC was paid off to direct the distribution of those $10 million to their favorite people.
Well, that's what I was going to say. Don't you think the SEC is a complicit instrument and a player in allowing this?
Yeah, they're captured by the industry, and they just pretend to really try to catch the insiders, okay? They're not interested in catching James Dimon from J.P. Morgan, who violated Title 18, Section 208, which is when he was sitting on the board of directors of the Federal Reserve Bank of New York, and they gave $55 billion to J.P. Morgan, where he owned 3 million shares of stock. That's a violation. That's a felony. But the SEC could have gone after him, or the FBI could have gone after him. I called the FBI. They say call the SEC. Well, but nevertheless, the SEC pretends to try to catch these people, but they're not really interested in doing it.
So who buys these puts?
Okay.
I want to kind of get back to that downgrade and the tipping off point before the downgrade. How do you know, and who's buying the puts?
I just looked at some articles that I wrote on my newsletter. I wrote an article on July the 12th where I saw an increase in what they call the VIX. That's the volatility index of the Chicago Board Options Exchange. And it usually happens that when the stock market goes up, the VIX goes down. And there's some subtleties as to why that's the case. But a couple of days I saw the VIX go up, not a whole lot, but go up when the market was up. That rarely happens. I believed it happened because people were buying out of the money puts in the Standard & Poor's Index, and that bid up those puts and calls and made the VIX go up. And so I smelled a rat. I didn't know what was coming, but I put out the word that I thought that in the near future there would be some event where the market's going to drop down. And so usually that happens when people are trading on inside information. So I think people were tipped as early as July the 12th to the downgrade. Okay? And so what happened was right after the agreement with the Republicans and the Democrats, they would avoid default and they would raise the debt limit or whatever they're going to do. You would have suspected that the market would have gone up, but it didn't. So the few days after that, it dropped. And then the downgrade came. You see, so I think that the drop prior to the downgrade was a result of people selling on the information that they knew the downgrade was coming, and then the following Monday the market was down 600. If you don't believe that they're trading on inside information, you can never be a market maker for too long because, you know, the general public, they think that the game is pretty honest. I think maybe 20 or 30 years ago, it was a lot more honest than it is now because they put people in jail, you know, in those days. Yeah, they got Madoff, and they got a couple of people here. But I think the SEC's captured. All they're doing is pretending. And this bit about this whistleblower.
What are you talking about? Explain it to us.
Okay. Well, the SEC now had allocated $45 million to pay off whistleblowers who can report cases of fraud or insider trading to the SEC, and the SEC will look at the information that's reported to them and then investigate, and if indeed the reporter of the fraud or the insider trading is correct, and he was more or less the first one or gave them substantial information to help with the investigation, they will pay him a certain fee. Now, I don't know how they determine the fee, but that was initiated, I think, August the 12th this year. And so if you think that you have some information about, like, for example, Google announced about a week or 10 days ago that they were buying Motorola.
Oh, no.
Right. And several days before that, even though the market was dropping, there was a very large number of calls traded on Motorola. You see? And so people suspect that there was buying pre-announcement about Google going to buy Motorola. And there was. That might be a typical case of insider trading.
What if everybody's doing it? And the fact is that whether it's legal